how you develop a bias. I'm on a daily time frame, and so this is what we're going to be keen off today. Just so you guys know, this was spoken about in my mentorship on the day it happened. Yes, it's in a replay mode, but this is just for educational purposes for YouTube. Today isn't really about entries, but it's all to do with a bias. There's various different videos about entries on my channel, and you guys have your own entry criteria too. So first of all, it's always important to identify the trend that you're in. I can see when I zoom in, what is GBPUSD doing on a daily time frame? So we can see that GBPUSD is dropping down, it's retracing, it's dropping down again, it's retracing, and then it's dropping down again. We've got a low here, we've got a lower high, we've got a lower low, lower highs, and lower lows. So in other words, what I'm trying to say is that price is moving lower. Then you have to think about, where is price in relation to its trend? It was beneath a low. And you guys know how I feel about, being active beneath lows. You need to be in from some kind of premium and then take it to this low to run out the liquidity. Not necessarily be trying to get all aggressive beneath these lows with sales like breakout sellers do. I'm not a breakout seller. I'm not a breakout trader. And so I don't do that stuff. Beneath old lows or beneath lows, you don't want to be aggressively selling. There might be like a really short-term opportunity, but you don't want to be aggressively holding onto sales thinking it's going to just keep on dropping because price is moving. Because the only people that think like that are retail concept traders who believe that when price breaks out of a certain zone or a certain area, it's going to keep on going in that direction. When price is beneath this lows, you have to be getting ready for some kind of retracement. And as you can see, price breaks beneath this low, runs out that liquidity, and it comes back into the range. When price pulls back, our new range is this high to this low. Price pulled back, and what did it do? It pulled back into some kind of premium price from the very low to the very high. I didn't have to bring out the fib tool, but I've gone ahead and done it because you can see it a lot clearer like this. Price pulled back to above this 50% line. It's retraced more than 50% of this expansion lower. So it retraced into a premium price before dropping again. So now we understand this. I just wanted to clarify that for all the people that don't really understand that. And now we get to this area over here. From this high, price then burst through these lows, run out the liquidity, run out all the self-stops beneath this level over here. So yes, you could have got some kind of move lower. As you can see, price continued to push lower after one tiny little retracement. But like I said, you don't want to be aggressively selling here. This needs to be something quick. This needs to be something really, really short term. When price is beneath a low, I'm going to take off some more. I'm going to take off some more. There we go. So when price is beneath a low now, or this technically is a potential low at this time, you don't know when this low is going to be ending, or you don't know when they're going to stop dropping. So this is a potential low at this point. But when price is beneath a low, you need to be getting ready for price to turn around. So now we understand that price in relation to its trend is beneath a low. And so what do you expect? So you would be expecting some kind of retracement, some kind of pullback into the range, ideally into a premium before it drops again, just staying in line with the trend. But we've gone over, you have to know the trend first of all. It's moving lower. You have to know where you are in relation to that trend. Is price expanding, making an expansion move, or is it retracing, or is it consolidating? So now, how do you know when price wants to pull back? That's the question. How do you know when price wants to pull back? So how you identify that price wants to pull back into the range is when it takes out a short-term high. So you can see right here, this is a short-term high. So when price trades through this short-term high over here, this is GU indicating to you that price wants to rally up to the upside for some kind of retracement. So I'm going to hit play. I'm going to play a candlestick at a time. There we go. So you can see 2 days later, what happened? Price traded through this high over here. And what I'm going to do, I'm just going to expand it for a little bit now. Short-term high, price traded through the short-term high on a daily time frame. And that's a big thing. If you can catch price trading for a short-term high on a daily time frame after it's expanded beneath a low, this is the sign letting you know that price wants to at least retrace. And so you're not going to be silly. What you're not going to do is you're not going to just jump in because it broke out the high and then try and catch a breakout move. After price trades through a short-term high, let me just quickly put some text in there. So this is our short-term high. There we go. After price trades for a short-term high, you need to be very sensible. You need to wait for price to retrace. And just because it's traded through here doesn't mean it's just going to stop. It can continue to push without retracing. And if it does that, that's it. It's all good. It happens. You move on. But ideally, you want to wait for some kind of retracement before you get in. You can see we pushed up a little bit higher. We took out the previous day's high. Don't forget, if you're not in this already, you don't need to be panicking. If it just goes off to the heavens now, then it missed you. Is what it is. You keep it moving. No need to, start judging yourself. Am I a bad trader and all this different stuff? Forget that stuff. What you need to focus on is, are they going to pull back to allow us to enter? And don't forget as well, on a lower time frame, on a much lower time frame than a daily time frame, above this high is a premium. So let's just say you're looking at the 50-minute time frame, the 5-minute time frame, or something like that. Let's go to the 5-minute time frame. On the 5-minute time frame, what's going on? So price made a lower low, lower high, lower low, higher high. This high is higher than this high. You're now at a premium on a lower time frame. So when people are doing breakout buying here, let's just say retail jumped in above this high because it was a breakout. It broke out of this high. It did a retest for them and it jumped up. And they would have caught something small in relation to the daily time frame, because the daily time frame, the pips are a lot larger. 60 pips is still wonderful, still good. You would have caught something there, and that's Gucci. But ideally, it's not necessarily the best kind of setup. 60 pips is blessed, don't get me wrong, but it's not the best kind of setup because we're going off the daily time frame here. On the 5-minute time frame, price is at a premium. You don't want to be buying price above an old high. You're buying at a premium. What would happen? Look at this. After it runs up 60 pips and then it drops again and it runs out some stop losses. These lows over here. Cool. So now we're back to the daily time frame. And like I said, this was all spoken about on my mentorship. I will show you my Discord post when I posted this. When price rallies up to the upside, what does it do? It leaves some inefficiency down here. And so I'm going to go ahead and mark up this inefficiency here. This would have been the area in which you expect them to come and provide even trading, and then price pushes off from here. This is what you're expecting because we've taken out a short-term high, which is big. That's the indication price wants to pull back. So you wait for some kind of retracement back into a discount, and then you go again. Don't forget, I'm combining that daily time frame with the lower time frame premium and discount. And not only that, when price runs for a short-term high, showing that it wants to go back into the range, you have to then go to the very high of the range, which is up here. Investigate your way down to find out what potential areas are high probability areas for price to reverse from. And so from the very high, we can see over here, we have this imbalance over here that price could get into, that one here. We have another imbalance over here that price hasn't fully filled up. So this was the whole imbalance. They filled in some of it, but not the majority of it, as you can see. So I'm just going to expand this to the right here. So we've got two sets of imbalances now that we could be looking to target for areas where price could potentially reverse. So the key thing now is to wait for a retracement. So I'm going to hit play again. There we go. Price trades into that imbalance. And so when price gets into here, this is where you'll be looking for reversal signs to take it higher. And like I said, when it comes to your entries, whatever your entry criteria is here, you wait for your entry criteria and then you take it to the upside. I will show you my Discord where I did mention this and spoke about this when price was in here too. And then what I was looking to do, like I said, is if this is our high and this is a low, if I take out this fib tool here, you can see this imbalance here aligns up with 50%. So really and truly, this is a high probability area where price can get to, because this imbalance is technically beneath equilibrium. It's not within a premium. So it should be a piece of cake to get to this level. So when the imbalance is within the premium, it's going to be harder for it to get to. It still might potentially get there. Okay, still might potentially get up here, but then this one should be easy. So this should be that easy trade from the imbalance to this imbalance, and then you're Gucci. And so I put this fib tool on just to show you where the imbalances are in relation to its expansion down lower. So over here, you can see that I posted this on the 21st of July. Okay, and you can see this is that short-term high, as you can see here. I don't know if I can zoom in on this, but you can see the short-term high, and you can also see the imbalance that I've aligned up, and you can see where price is. This isn't no replay mode, this is on the day. I've got other things I'm looking at above reference points, but ultimately I'm looking at the imbalance here. Cool. And then what I said was, I like how GU has traded through a short-term high and retraced into a daily imbalance, showing it wants to trade higher. So now when it comes to my target, I'd like a retracement minimum into the imbalance at 122,000 or 12200, however you want to put it. And then if it trades through that, then I want 1.2500. So you can see that up here, this is the imbalance I was referring to, the one at 2200. And so this is the one that's within a premium. I'm always going to be looking to target the point of interest within a premium, but then there's obviously going to be point of interest along the way. And so this one is the easy money, just for price to fill in this imbalance. It's beneath equilibrium. It should do it with ease. So my buys from when price was down here, this one I'm looking for some kind of buy setup to take price higher. So this is why you saw me all over GBPUSD on Instagram. I was buying from this level, as you guys saw, and I took it right up into these highs. You always target the high it came from. And then I will show you the Instagram posts as well, so you guys can see all the Instagram posts. I was all over GBPUSD, and those were the reasons why. To show you guys what happened, there we go. And they come back into the imbalance. I'm going to go down the time frame to show you this real quick. So this is how it looks on a 1 hour time frame. This is when they expand, they take out the short-term high, they retrace into the imbalance, they then take out the high. There's another short-term high, this one here. take out that short-term high, and then they retrace again. They gave another opportunity to jump in here, and then once again they expanded again higher. They retraced again. This would have been another opportunity to jump in with more buys. You always want to wait for price to trade back into a discount. So every single time frame is going to have its own premium and discount, and then once you're at a discounted price, you take it back up into a premium above this high. This is where you'll be taking partials, and then once again, if you miss this buy over here, you wait for price to drop back into a discount. They create relative equal highs, and then they go again. Okay, and so obviously you guys know what happened here. This is FOMC, and so far, like I said, this is where I want them to get to. I want them to get to here. They clean up this inefficiency already, so that's done. This is the imbalance I'm looking for them to come and clean up. I wanted to add something onto everything I've spoken about so far. This is that daily short-term high, but I want to show you how you could have gotten involved even a little bit earlier. And there are going to be ways you can refine it even more, and I do chop that up in my mentorship as well. But then check this out. So I'm in a 50-minute time frame now. This is below that daily imbalance. There could have been ways you could have gotten even earlier, or had a buy bias even earlier. You see, on 50-minute time frame, this is the very low, and so now on the 50-minute time frame, we have a last down close candle here from this high to this low. We've run out that liquidity to the left, and then look what happens. Look what happens. Once again, if I just expand this to the right, when do we violate this high? We violate the high over here. And so once again, just like I've shown you on the daily time frame, you could have done this on a lower time frame too. After price violates the high, you know you're going to get some people that say, okay, it didn't really violate the high, that it was probably a wick violation and stuff like that. And I've spoken about this on my channel before. Wick violations are still a break of a high. If it didn't want to get above this high, if it wanted to protect the high, it would have done it. It never did it. So after it takes out the high, this price then retraces back down into what? Into this imbalance over here. This could have been an opportunity for you to get in even earlier. It even returns to the imbalance one more time and then takes off. And so there are ways to refine it even more. You don't have to wait for the daily time frame break. You can take the lower time frame break to the daily time frame break. So that's a nice little trick that you guys can go ahead and back test and let me know how it goes for you. So that is how you develop a bias. You look at that daily time frame, you understand in which way the market is moving. So is it moving lower or higher? Is it going sideways? Technically, if it's going sideways, you just want to stay out. But if it's dropping, after it takes out a low, wait for a short-term high to be taken out. Wait for price to drop down into your point of interest that's within a discounted price. This is if you're buying. Once you're within your point of interest, in this scenario, it was the imbalance on the daily time frame. Whilst price is within your point of interest that's within a discount, this is where you should be looking for some kind of buy setup to then take price higher and at least target the high it came from. And if you missed that, look for the next opportunity. There was multiple higher highs and higher lows you could have got in at discounted prices. If you're not trying to catch all of this and catch, a little swing trade, then you target the high it came from.